Every loan has a story. It's like embarking on an adventure complete with twists, turns, and the occasional hold up, did that really just happen moment. Now picture yourself as the hero navigating through the loan jungle, armed with calculators, paperwork, and a good dose of patience, which you are going to need. Today, I'm breaking down the 4 key phases every loan goes through. And by the end of this video, you're gonna feel like a loan funding ninja, ready to tackle any deal that comes your way. Oh, and if you're thinking about becoming a loan officer, then make sure to stick around, because I'm also going to share how you can kickstart your journey and maybe even join my team. Spoiler alert, we are hiring. My name is Zevi Shafran, and I'm the owner of a company called Brook, a residential and commercial lending shop based in sunny Los Angeles. I've spent my days helping people turn their property dreams into reality and occasionally rescuing deals that seem more doomed than a sequel to a really bad movie. Now, a quick heads up, if you're interested in joining my team, shoot your resume to the email in the description below. Or if you want to step into the exciting world of commercial lending, check out the Part-Time Commercial Lender Academy, which is my plug-and-play system to help you close larger deals without breaking a sweat. The link is in the description. Go ahead and click on it after this video, of course. And hey, while you're here, smash that like button, please, so other awesome folks like yourself can find this video on the internet. With that, let's dive in. First phase is discovery. Imagine yourself as a Sherlock Holmes minus the pipe and the hat, unless you're into that kind of thing. This phase is all about uncovering the borrower's story and figuring out if they actually qualify. And here's what you're looking for. Liquidity issues. Borrower says that they've got 20% for a down payment, but they only have 10%. You can't fund a loan on good vibes. Income gap. They need $100,000 to qualify, but they only make $50,000. My quick math tells me that that's not going to fly. And for self-employed borrowers, if they are self-employed, be prepared for alternative documentation, fun, and by fun I mean more work for you, and no minimal down payment options. Pro tip, ask upfront questions like, what's your price range? Most people have a number in mind. And if it's laughably high, save yourself the trouble. How much do you have for a down payment? And don't stop there. Are the funds seasoned in the account for 60 plus days? Or is this money coming from Aunt Margie's holiday gift fund? Oh, and don't forget to whip out a trusty mortgage calculator, which is available for you at loanbrook.com, and run the numbers. If the payment is more than 50% of their gross monthly income, adjust the loan amount. Trust me, I've made this mistake so many times, and it isn't fun. Phase number 2 is presenting the terms. Before you gather a mountain worth of documents, set the expectation. Borrower loves surprises about as much as you love finding out that your Uber Eats order is missing your French fries. Send them a simple email that outlines the loan terms in plain English, something like, here's what your monthly payment is, interest rate, and fees look like. Are you cool with that? And wait for a yes, I'm in before moving forward. This step will actually save you from the dreadful I did not agree to this conversation, which is coming right down the line. Now, phase number 3 is underwriting. Oh, underwriting, the phase where the borrower's story either checks out or takes a plot twist. Spoiler alert, there is always a plot twist. The borrower swears that they have a 750 FICO score. Surprise, it's 680. The car loan they forgot to mention, yeah, that will blow up their debt-to-income ratio. Assets listed as $100,000 are actually $10,000. Here is your mantra. Stay calm, adjust the terms, and for the love of coffee, keep your borrowers informed every step of the way. Ghosting isn't cool, whether it's dating or underwriting. Moving into phase number 4, you've made it to the finish line. Closing is the grand finale where everything comes together or falls apart if you're not prepared. Clear the close. Make sure all the conditions are met so there are no last-minute freakouts. Review the docs. Borrowers should know exactly what they are signing. Nobody likes surprises, especially not in the fine print. Celebrate. Once everything is signed and funded, it's time for the confetti, or at least a heartfelt thank you email. Pro tip, after closing, follow up with your borrower. A quick congrats on your new home can turn into referrals much faster than you can say, I'm gonna need more deals. And there you have it, the loan journey from start to finish. Sure, there are some bumps along the way, but with a solid process, you can tackle anything. Here's real talk. While residential lending is great, it's a great way to start. I would recommend exploring commercial loans, and here's why. Bigger loan amounts equal larger commissions. Loans are not tied up for 30 years, giving you so much more flexibility. And my favorite part is collaborating with residential loan officers who can actually get paid legally through closing. So everybody wins. If you're ready to level up, check out the Part-Time Commercial Lender Academy, available for you in the description below. It's the shortcut that I wish I had when I got started in lending. I thank you for watching. Please don't forget to like, subscribe, drop me a question in the comments. I really do love hearing from you. Let's keep funding deals together, one loan at a time, and I'll catch you again on my next video. Take care.